Setting up a U.S. single-member LLC as a Canadian resident seems like a simple, flexible way to do business across the border. And on the U.S. side, it often is, but there's a hidden tax and compliance trap waiting for many Canadians. This stems from one critical fact. The U.S. and Canada classify the exact same LLC in two completely different ways. This is what experts call the LLC mismatch, and getting it wrong can lead to surprise penalties, double taxation, and a mountain of paperwork. I'm Zarshan, and in the next few minutes, we'll break down this mismatch. We'll look at where the problems show up and the practical steps you need to take to stay compliant. In the US, a single-member LLC is classified by default as a disregarded entity. This means it is invisible for tax purposes. The income flows directly to the owner. In Canada, that same LLC is typically considered a corporation under CRA's interpretation. This creates a mismatch in how income is treated. Three consequences arise: timing, character, and forms. Timing. Income may be taxed in different years. Character. One country sees it as business income, the other as dividends. Forms. Canadians may face T134 and/or T135 requirements, even without revenue. Even if the LLC is disregarded, if you're a foreign owner, you're still responsible for Form 5472. Up to 25,000 USD penalties for each 5472 if not filed properly and on time. You also need a pro forma Form 1120 if there's a reportable transaction. For example, this might be paying the LLC's expenses from your personal account. You can elect corporate treatment using IRS check-the-box rules. That aligns the U.S. view more closely with Canada's, but may trigger additional filing requirements, double taxation, and complexity. Back in Canada, the corporate view leads to two compliance risks. Repatriated profits, even as passive income, e.g. was dividends, don't eliminate the T134 filing if you own or control the LLC. Penalty for not filing in $2,500 per T134. T135 is needed for specified foreign property over $100,000. If the CRA sees you exercising central management and control in Canada, your US LLC might be taxed as a Canadian corporation. Before scaling your US LLC from Canada, use this checklist. Track service location. Avoid ECI by staying outside the US when performing work. Document owner transactions. Even reimbursing LLC expenses can trigger Form 5472. Plan repatriation and determine how to move profits to Canada in a tax-efficient way. To recap, the US-Canada LLC mismatch is a real compliance risk. Not just income tax, but also classification, timing, and form overload. The Canada-US tax treaty can sometimes help with withholding taxes or foreign tax credits, but only with proper planning. Stay proactive. Consult qualified cross-border professionals. Choose the right structure from the start. This video is general information, not tax advice. For tailored help, book an appointment with our cross-border tax team at www.dcpa.ca. If you found this helpful, please like, subscribe, and leave your questions below.